Hey everyone! Last week, the Fed announced a 25 basis point increase in the overnight rate, taking it to the 4.5% to the 4.75% range. The 25 basis point increase was well anticipated by investors, so that's not the big takeaway. For commercial real estate investors, the important factors actually came out in the press conference following the rate increase. Chairman Powell made three statements that have the potential to boost commercial real estate investment activity. First, Chairman Powell said, "We can now say the disinflationary process has started." That's really important because it will shape the Fed's strategy going forward. The Fed will be under less pressure to increase interest rates. Second, Chairman Powell said, "I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment." That's another strong positive. Remember that in statements last year, in August, in September, in November, and even December, Powell was saying things like there will be pain and that unemployment would need to go up to 4.4% or 4.6% to get inflation under control. The shift in tone suggests that the Fed no longer thinks they need to cause a recession to get inflation down. The third statement that caught my attention was that ongoing rate increases are likely needed, but we will revise our outlook at the March meeting. This is a significant step away from where we were a few months ago when the Fed was strongly telegraphing significant rate increases. These are all very positive indicators for the commercial real estate market. Last week, I met with hundreds of investors at the National Multifamily Housing Council Strategy Meeting, and the sentiment was solidly positive. Although most investors remain in a cautious wait-and-see stance, there was also a lot of enthusiasm for rising activity this year. It was almost like they're waiting on the sidelines for someone to yell, "Game on!" That might be the message we just heard from the Fed. The Fed's shift to smaller rate increases and a more stable monetary outlook is delivering an important change, a change in tone and a change in outlook. And that's putting downward pressure on commercial real estate borrowing rates. The 10-year Treasury fell back down to the 3.4% range, the lowest we've seen since September last year. In addition, lenders have already started to tighten up their lending spreads, which is also moving borrowing rates lower. If inflation continues to decelerate, as it has since it peaked last June, then borrowing rates could soon stabilize, in turn adding momentum to the price discovery process in earnest. Yes, borrowing rates are higher than they were a year ago, and that's putting upward pressure on cap rates, but it looks like interest rates are beginning to stabilize, and that will allow the market to calibrate their pricing. As I've alluded to in past videos, the February 1st Fed rate announcement could be the watershed event that brings stability to the commercial real estate investment market. With goods inflation dropping and housing inflation stabilizing, we may be at the turning point that allows the Federal Reserve to take a step back. Once the destabilizing forces created by the rapid Fed rate increases are alleviated, investors will begin the price discovery process and transaction flow may begin to pick up. That process will take several months. It won't be an overnight event, but this is a positive sign that the market will start down that path. As we get more clarity on the short-term outlook and investors start to close the expectation gap, I want to remind every investor to look forward. Focus on what the supply and demand metrics for commercial real estate will look like as the economy enters a new growth cycle and what they'll look like in 3 to 5 years. Because at the end of the day, investors need to keep their eyes on the horizon.